Welcome to Capital Logic. Most people think they understand how Airbnb survived the 2018 financial crisis by selling cereal. They don't. Today we are going beneath the surface to show you what's actually happening. If that kind of analysis is what you're looking for, like this video and subscribe now. Here's what the numbers really say. Airbnb didn't survive the 2018 financial crash by disrupting real estate or booking software, but by selling $40 boxes of novelty breakfast cereal to pay off their maxed-out credit cards. It sounds like a desperate gimmick, but it was actually the ultimate masterclass in bootstrapping when failure was no longer an option. Stay until the end. I'll break down 3 lessons from Airbnb's playbook you can apply to your business this week. If you want business breakdowns you can actually use, hit subscribe and the bell. In October 2017, long before the multi-billion-dollar valuations and the global brand recognition, Airbnb was born out of pure, unadulterated desperation. Back then, it wasn't even called Airbnb, it was Airbed and Breakfast. And the entire business model was conceived because founders Brian Chesky and Joe Gebbia simply needed to make enough money to cover their San Francisco apartment rent. The concept was simple, almost absurdly so. 3 design conference attendees slept on inflatable air mattresses right in the middle of their living room, paying $80 a night, complete with homemade Pop-Tarts for breakfast. It was a makeshift solution to an immediate cash flow problem. But as the months rolled on, that living room experiment morphed into an ambition. They realized they weren't just renting out air mattresses, they were building a global marketplace for peer-to-peer lodging. There was just one catastrophic problem. The macroeconomic landscape was collapsing in real time. As 2018 wore on, the U.S. financial crash slammed into the global economy. For a traditional startup, this would be the moment to secure a safety net of venture capital. For Chesky and Gebbia, it was a brick wall. They took their pitch to Silicon Valley, meeting with 15 different angel investors. The response? Silence and outright rejection. Half of those investors didn't even bother to reply, and all 7 formal pitches resulted in a hard no. Investors looked at the concept of strangers sleeping on strangers' air mattresses and laughed them out of the room. Meanwhile, reality was closing in. The founders' credit cards were completely maxed out. They were juggling mounting debt, funding the platform entirely out of pocket, and staring down the very real prospect of eviction from their apartment. Brian Chesky was literally sleeping on an air mattress himself, waking up every single morning to a gnawing panic. They had 0 institutional backing, 0 monthly revenue, and a product that the establishment deemed too bizarre to touch. Traditional venture capital had completely shut its doors. When you have no money, no investors, and rent due tomorrow, standard business logic goes out the window. You stop playing by the rules because the rules are designed to let you fail. That was the exact headspace Chesky and Gebbia occupied in August 2008. The U.S. presidential election was hitting a fever pitch, dominating every news cycle and capturing the collective attention of the entire country. And that's when they spotted their opening, not in software, not in real estate, but in the grocery aisle. If people wouldn't buy into their digital platform, they had to manufacture something physical, something impossible to ignore. They decided to launch a limited edition breakfast cereal line. They bought cheap, generic cereal boxes at Costco, took them back to their apartment, and manually assembled and hot glued the cardboard packaging themselves. Leveraging their formal backgrounds as graduates of the Rhode Island School of Design, they designed the packaging down to the millimeter to mimic real supermarket brands, catching consumers completely off guard. They split the production down the middle, creating 2 distinct political variants. 500 units of Obama O's, dubbed the Breakfast of Change, and 500 units of Captain McCain's, promising a maverick in every bite. Political neutrality wasn't the goal here. Capturing market share from both sides of the political aisle was. By creating a variant for both Democrats and Republicans, they hedged their bets and targeted the tribalism of the electorate. But pulling this off wasn't cheap. The production cost for designing, printing, and filling those 1,000 total boxes totaled around $20,000. For 2 founders on the brink of eviction that required draining every last drop of financial liquidity they didn't have. They were gambling everything on a box of breakfast food. To turn those boxes into survival capital, they needed high-density foot traffic and plenty of disposable income. So, they packed up their inventory and shipped themselves straight to the 2008 Democratic National Convention in Denver, Colorado. The convention was swarming with thousands of wealthy political delegates, journalists, and high-spending junkies. and Chesky and Jebbia were right there in the thick of it, hawking their handmade creations. They slapped an exorbitant $40 price tag on each box. Let that number sink in for a second. They took a $4 base of generic supermarket cereal, slapped some political satire on the cardboard, and marked it up by 1,000%. It was an audacious psychological play, weaponizing status symbols and collector mentalities right in the middle of a brutal economic recession. And remarkably, it worked. The political elites loved it. The novelty factor, the hand-numbered boxes enforcing artificial scarcity, and the sheer audacity of the stunt drove immediate sales. Within weeks, the campaign generated roughly $30,000 in total revenue. After subtracting their $20,000 production costs, they walked away with a net profit of $10,000 to $20,000 for their survival fund. It was enough to clear their mounting credit card debt, pay off their back rent, and buy themselves a little bit of breathing room. But more importantly, the $30,000 payoff wasn't just a financial injection. It was the spark that caught the attention of the tech world's biggest gatekeepers. The cereal stunt bought them precious time, but it wasn't a scalable business model. By early 2009, the founders needed more than a quirky PR gimmick. They needed institutional validation, and fast. Before the cereal lifeline, Airbnb, then called Airbed and Breakfast, had met with 15 angel investors in Silicon Valley. Half didn't even reply, and all 7 formal pitches resulted in outright rejection. Traditional venture capital wanted nothing to do with 2 RISD graduates renting out air mattresses on strangers' floors. Enter Y Combinator. During their pivotal interview in early 2009, Brian Chesky and Joe Jebbia didn't just walk into a room with a slide deck. They brought a single surviving box of Obama O's as a physical prop to demonstrate the kind of sheer, unhinged hustle that spreadsheets simply couldn't capture. It was a brilliant psychological gamble. Paul Graham, the co-founder of Y Combinator, was initially skeptical of the core home-sharing concept, viewing it as entirely too bizarre. But he was utterly captivated by the founders' relentless execution. Astonished by the stunt, Graham later admitted that the cereal campaign was the single best founder pitch he had ever encountered. He reasoned with mathematical simplicity. If you can convince people to pay $40 for a $4 box of generic supermarket cereal, you can convince them to sleep on a stranger's air mattress. That single box of cereal cracked open the doors to Y Combinator's W09 batch, injecting the startup with its first true institutional credibility and a lifeline of funding. With institutional backing secured, the newly minted startup began restructuring its entire approach to growth throughout 2009. First, they officially shortened the cumbersome name from Airbed and Breakfast down to Airbnb, streamlining their identity for a digital-first audience. But the platform still suffered from a fundamental trust deficit. Users were posting blurry, poorly lit cell phone photos of their spare bedrooms and living room floors, and bookings were virtually stagnant. The founders realized that people weren't booking because they didn't trust what they were seeing. So they grabbed a camera and did something entirely non-scalable. They flew to New York City, rented a high-end camera, and personally photographed the apartments themselves. Within a week, the listings with professional photographs saw their weekly revenue double. That manual intervention quickly transformed into a global network of trusted freelance photographers, turning a bespoke hack into a foundational product feature that instantly bridged the psychological gap between strangers. At the same time, CTO Nathan Bletrick deployed one of the most aggressive growth hacks in Silicon Valley history. Recognizing that Craigslist was where their exact target audience was already looking for short-term housing, Airbnb built a seamless integration. With a single click, hosts could cross-post their listings directly onto Craigslist, siphoning massive pools of active traffic right back to the fledgling platform. It was gritty, it bypassed traditional customer acquisition channels entirely, and it engineered a hockey stick growth curve out of pure software engineering resourcefulness. For over a decade, that combination of guerrilla marketing, relentless platform optimization, and trust-building design carried Airbnb through a meteoric rise. They scaled into a multi-billion-dollar global behemoth, expanding across hundreds of countries and transforming modern travel. Until March 2020 hit. Suddenly, the entire global travel industry ground to an absolute halt overnight. Overnight cancellations wiped out months of projected revenue, and Airbnb faced an existential crisis that dwarfed their 2008 cash crunch. It was the ultimate stress test. Decades after their very first transaction involved three design conference attendees sleeping on inflatable air mattresses for $80 a night, the company was staring down the barrel of total collapse once again. Faced with a collapsing market, management didn't panic. They reverted to their foundational DNA. They executed an aggressive survival playbook, cutting marketing spend to zero, slashing operational overhead, raising crucial emergency capital at a steep valuation, and pivoting their entire strategy away from international tourism toward domestic, local travel. When lockdowns forced people to stay close to home, Airbnb quickly adapted its platform to highlight drive to destinations, remote work getaways, and long-term neighborhood stays. It was a masterclass in corporate resilience, proving that the survival instincts forged in a cramped San Francisco apartment back in 2008 were still embedded deep within the company's core. They had survived a financial crash by selling cardboard boxes of novelty breakfast food. And a decade later, they survived a global pandemic by fundamentally reimagining where people live and traveled, proving that when the playbook burns, execution is everything. Now here are 3 lessons from Airbnb's playbook you can apply to your own business. Lesson 1. Leverage extreme constraints to spark creative marketing. When low on capital, invent an unconventional guerrilla marketing campaign that forces media attention. When Brian Chesky and Joe Gebbia were drowning in credit card debt, they didn't buy digital ads. They boxed cereal and pitched political conventions, turning a desperate cash flow hack into a national news story. Lesson 2. Demonstrate relentless founder hustle to win investors. Use tangible proof of your resourcefulness instead of just a slide deck when pitching. When Y Combinator's Paul Graham saw founders willing to sell cereal just to keep their lights on, he realized these were people who simply refused to die. Lesson 3. Take direct operational control of early user acquisition. Manually visit and help your first customers to ensure product market fit and build early momentum. The founders didn't sit back and wait for listings to roll in. They flew to New York, rented a camera, and personally took photos of every single apartment to make the platform look legitimate. If you want more business breakdowns you can actually use, subscribe. I'll see you in the next one. Now you know what most people never bother to find out about: how Airbnb survived the 2018 financial crisis by selling cereal. The question is what you do with that knowledge. Subscribe to Capital Logic for more breakdowns like this one, and hit the notification bell so you catch every episode. The next case study drops soon.